I make money through a lot of different ways, as well as rental income from my properties. I don't pay any taxes on the money that I make. Hey there, welcome to part 3 in my video series of why I love real estate. Today, we are going to be focusing on the tax benefits of real estate and why I love them. Now, if we're going to talk about taxes, first off, I understand that the concept might seem boring. And on the other end of that, it might make people angry. Nobody likes paying taxes, but we all like making money, and taxes are associated with making money. So this is one of those pills we just have to swallow. In today's video, I'm going to share with you ways that making money in real estate can actually save you tax dollars. Now, a lot of people don't realize this, but the tax code is so favorable towards real estate investors, it almost seems like it was written for our benefit. In fact, in my specific case, I don't pay any taxes on the money that I make because I have a CPA that has helped me come up with strategies to use where I make my money through real estate and therefore I don't have to pay taxes in it. The first thing you have to understand if you want to save money in real estate taxes is the concept of depreciation. Now, depreciation is not the opposite of appreciation. Appreciation is what we say when the value of your house goes up. Depreciation does not mean that the value of your house went down, at least not in accounting terms. In accounting terms, depreciation refers to the fact that your asset, the property itself, is slowly falling apart over time. And the government recognizes that your house or your commercial building is falling down over a period of time, and they let you take a write-off because of that. The government has given a useful life of 27 and a half years for residential property. When I say the government, what I'm really referring to is the Internal Revenue Service, or the IRS. So what does that mean in layperson's terms? If you buy a house that's $500,000, they're going to subtract the value of the land from that asset and say the structure itself can be divided by 27.5, and you can take a write-off of whatever that number is. So let's say in this case, you bought a property that was maybe $700,000 and the land is worth $200,000. So the structure is worth $500,000. If you divide 500,000 by 27.5, you get $18,181. Now that's what you can take off of the income that that property creates through depreciation. So if the property generates $20,000 of income in a year, you would subtract the $18,181 and be left with a little bit more than $1,800 in actual revenue that is taxed. So if you're sitting at a 20% tax bracket, you would only be paying 20% of that $1,800, not 20% of the full $20,000 that you made. This is a huge, huge, huge benefit for people that make money through real estate. And that's how depreciation works. Now, recently, the tax code has been altered to where there is depreciation on steroids opportunity. And I had to start with depreciation so I could get you to understand some of this. The IRS will also let you take certain elements of your property that wear out faster than 27 and a half years and subtract the value of their loss in year one. Your appliances aren't going to make it 27 and a half years. A lot of the plumbing in the property isn't going to make it 27 and a half years. The carpet isn't going to make it 27 and a half years. So there's a tool called a cost segregation study where an expert is hired to come and say, all right, the cabinets, the countertops, the appliances, all the individual pieces of this property have a useful life that is less. And they let you compress all of that as stuff and take it as a loss in year one, which means you don't have to spread it out over 27 and a half years. Now, what this means for real estate investors is that you can take a lot of the depreciation up front rather than spreading it out over a long period of time. We often call this accelerated depreciation, and it's done through a cost segregation analysis. So let's talk about how that could work in real world terms. Well, let's say you have a property that's making $100,000 a year, but your depreciation is only going to cover $50,000 of that. Well, by doing accelerated depreciation through a cost segregation study, you could theoretically get to the point where you take a $100,000 loss in depreciation in year one, so you don't pay any income on what that property made you. And if you buy a property every year doing the same thing, you can continue this strategy. Now, it works best when you pair it with a third tool, and that is the status of a full-time real estate professional. Now, I'm not a CPA and I'm not giving legal advice, so I just want you to understand. I can't tell you exactly what that means. I can connect you with my CPA and he will. So just send me an email and I'm happy to do that. But as a full-time real estate professional, you get this awesome perk. Instead of just taking the income that comes from that one property, you can take all the income that you earn through real estate related activities and use your unused depreciation from that one asset to shelter the income that you made in these other ways. So what does that mean in practical terms? Well, I make money through real estate commissions. I make money through mortgage loan officer commissions. I make money through book sales. I make money through flipping houses. I make money through teaching people how to invest in real estate. I make money through a lot of different ways, as well as rental income from my properties. By making sure I buy enough real estate that I keep my depreciation number very high through accelerated depreciation, I can offset the income that I made in these areas as well. And that's how I keep my taxes at zero. Now, I don't want to make it sound like this is easy.
That was easy.
You got to buy a lot of real estate. You got to work really hard. You got to take the work and the risk associated with buying multiple properties in order to do this. But where else can you take the money that you earned at your job, invest it into something that will earn you more, and then save in taxes on the money that you made? This is why I say it's almost like the IRS wrote their rules to benefit real estate investors. Now, why would they do that? Well, first off, they understand that when you buy property, other people win. It gives people a place to live, and it takes a lot of the burden off of the government to provide public housing. You also create jobs for a lot of other people that do pay taxes. So while you may be saving a lot in taxes, you're making the government much more money by employing a lot of people, and they're smart and they figured this out. So because you're smart, I just want to ask you, do you want to be one of the people who is getting taxed on the money working in real estate, or would you rather be the person who is not having to pay taxes because you owe it? Well, if you become a real estate professional full time, you get all the benefits of making money through real estate, and you get all the benefits of ownership, and you get all the benefits of not being taxed in either area. And that's what I want to recommend to everybody here. I love real estate because of the tax benefits that it provides. It helps accelerate your wealth building as well as accelerate personal growth. Now, you may be fascinated about this. A few things that I just want to put out there. If you don't buy a lot of real estate, these strategies don't work super well. If you're not a full-time real estate professional, you can't take advantage of the full power of what I'm talking about. And if you buy very cheap real estate, a cost segregation study doesn't always make sense to save money. But if you do take this serious, please email me and let me introduce you to my CPA so that they can save you some money as well. And if you know someone who's wealthy, but they're getting hammered in taxes, please send them this video so they can learn a little bit more about how they can make a couple changes to not get hammered in taxes. I'd much rather see people who build wealth through real estate pouring that money back into their portfolio, back into the public, back into the world to make it a better place than just giving it to the IRS to spend on God knows what. I really hope you enjoyed this video. If you're thinking this is too good to be true, I assure you it's not. If you're thinking this is a scam or a loophole, I assure you it's not. If you're thinking this wouldn't work for you, I would ask you, what can we change so that it would work for you? The David Green team is here to help you buy more real estate. The One Brokerage, the company that I own for loans, is here to help you finance that real estate. These videos are free for you to help you see the reasons why you should be taking advantage of this. I'm doing everything I can to help you build wealth in the same way that I am. All that I ask is you can subscribe to my channel, leave me a comment below, and share this video with someone you love so that they can do the same thing. Thank you very much for watching. I truly appreciate the time and attention you're giving me. Please check out one of my other videos, especially part 4 in this series of why I love real estate.